All right. So remember now, ladies and gentlemen, here, what do we have? We have a situation where we have infinity. And we are saying that whenever there is infinity, we must always remember the provincial who? The provincial officer. And the formula, I've been able to write the formula for you of provincial officer. So anytime they talk of infinity, always remember the provincial officer concept. Please, provincial officer ni jina kejeli provincial officer equals district officer into 1 plus growth rate all over Kenya minus government. Kenya without government. Ladies and gentlemen, please listen and listen to me very well. For us, this PO, as we shall be seeing it, O means what here? Current. So this is the current market price per share. This is the current market price per share. That is our PO, the current market price per share. And then we have DO. DO is the current dividend. This is the current dividend. This is the current dividend, current dividend per share, DPS. Actually, I should have used here DPS, current dividend per share, current dividend per share. And then we have a KE. KE here is cost of equity, is cost of equity. KE is cost of equity. In our case, we shall be using this as our cost of capital. Cost of capital. We shall be using this as cost of capital. And then we have a G. G is the growth rate. 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 Now, ladies and gentlemen, please listen and listen to me very well. In this case here, we are evaluating an infinite cash flow. So basically, I would want to have here my PO. Then how do I treat this? How do I, remember here, I don't have dividends. I'm only borrowing that formula for purpose of getting this cash flow here. So the most current cash flow is this 25. So I'm trying to plug in. We are saying that this will be 25 into 1 plus the growth rate, the perpetual growth rate. The perpetual growth rate is 0.02. So here we have 0.02 all over the cost of equity. In our case here is the cost of capital. And I remember vividly that our cost of capital here was 10%. Our cost of capital here was 10%. You see 10% is the same as 0.1 minus 0.0 growth rate, which is 0.02 like that. So here you have to be very careful. First of all, you will have to get the numerator separately and then the denominator separately, and then you give us the quotient. I'm so sure this thing now looks very technical, but you're going to love it. You shall love it because it shall always be there in your exam. You've got no two ways about this. You must understand this. You must understand this. So please give me the numerator. Is there somebody who can give me the numerator here? 25 times 1.02, 25 times 1.02. What do we have here? Somebody 25 times 1.02. What do we have? Somebody here. 25 times that. So I'm being given here by a Crispus. Thank you very much. 25.5. So this is 25.5. How about this denominator? 0.1 minus 0.02. I'm being told by Gordon here, it is 0.08. Thank you so much. So then is there somebody who can give me the quotient? When we divide the two, we divide this and this, what do we get at the end of the day? When we divide the two, what do we get at the end of the day? I'm being given a figure of 318.75. I'm being given a figure of 318.75 like that. This is the answer I'm looking for. So instead of having so many issues here, this is the figure that I should bring here as the cash flow of year number 4 to infinity. So year number 4, remember the growth rate is 2%, but the cash flow is this 318.75 like that. Is that 318.75 like that? And then remember the PV will remain the same because the cost of capital is still 10%. So year number 1, correct. Year number 2, correct. Year number 3, correct. But how about now the PV? How about the PV for this year 4 to infinity? Year 4 to infinity. Remember, I've been able to lump it together and I brought it here like a lump sum amount. What do you think in this case here, Will? What do you think could be the PV for this infinity amount? drop down. I like what David is telling me, drop down. So for the infinity, you simply drop down this. You use the immediate predecessor, PVIF. So this PVIF here for the last year will be used twice. This is the same figure. You shall come and use here. 0.75 what here? 13. 0.75, 13. 0.75, 13. You'll get used to this. The most important thing is for you to know that once you've used the provincial officer formula, you've been able to get a lump sum figure that you'll bring here as your cash flow. The PV for this cash flow, it will be a drop down. It will be a drop down. It's like you say, just enter in Excel. It gives you like that. It's a drop down. Ladies and gentlemen, after that, would you be kind enough by coming here and creating a column for present values, or discounted cash flows, So we have here present value. So present values, like the first one will be this cash flow times the PV, which in this case is giving us 9.091. And then the second one will be 15 times this. 15. Please ensure you're asking questions without fearing. 12.396. 12.396. Thank you very much. 12.396. And then we have year 3, which is 25 times this. 25. So we have 25, 18.73, 18.783. And then lastly, we have now this 318.75 times this. 318.75 times this 0.7513. What figure are we getting there? Somebody who can give me this figure. Mosioka Mosao, Mrs. 239.477. 239.477. So then could you kindly give me this total present value? Kindly give me this total present value. Is there somebody who can give me this total present value? Is there somebody who can give me this total present value? These guys are not talking to me really. These guys are not talking to me really nicely today, right? So they're telling me it is 297.747. 297.4. 279, sorry. 279. 279. Can someone else confirm this figure? Can someone else confirm this figure? Can someone else confirm this great figure? 279.746. Somebody has confirmed that. And now that takes me straight away to this question that we were doing in our last class, the November 2016 question number 1A. No, not November. It's May 2016 question number 4B. May 2016 question number 4, boy. November 2015, November 2016. Why am I talking of November? It should be May 2016. May 2016. Question number 4B. May 2016. Question number 4B. I remember we had already done part A. Now was simply how do we access the past papers? Is there somebody who can share that link with us? There is a very important link that all CASNEB students should be having. Very important link of past papers. Is there somebody who can share that link with us here? And then once you get that link, please ensure that tomorrow you get to your workplace. In your workplace, ensure that you print all those papers and put them in a file. So I'm giving you permission to go and steal your employer's resources. That's not theft, because whatever knowledge I'm teaching you here, who will it benefit most? It's him. It's him or her, your employer. Great. Thanks, Paul. Thanks, Elizabeth. You can see now that once you click on that link, you'll be able to get access to, don't print all of them, print for the papers that you're doing. Like now you'll print for AFM, Ladies and gentlemen, this is May 2016 question number 4B. Do we have access to this question, all of us? Hooray. Are we there? Do we have access to this particular question? So John says yes. How about the other students? Yes. Great. Yes. Thank you so much. So we are reading this very fast. And of course, for those of you who have got these revision kits, we sell these revision kits at a very throwaway price, just 1,000 shillings. You simply need to acquire this revision kit as well. So in this case here, this revision kit, which has got CASNEB questions and answers, Call this guy tomorrow. He'll be able to tell you how will you get you'll get this book at 1,000 bob. So we are told something very interesting here. Huge Limited intends to take over Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings of 86 million next year. If Huge Limited acquires Tiny Limited, the expected results of Tiny Limited for the next years will be as follows. I can see the results there. So they want us to give them the offer price for Tiny Limited. If Huge Limited were to value Tiny Limited on a forward price earnings multiple of 8 times. I showed you how to value an organization using the PE ratio method. I showed you this using the PE ratio method. I showed you this. How do we value an organization using PE ratio method? It's very easy. We say the total value, total firm value equals the PE ratio given times something. Somebody who is able to recall this. But anytime they want us to, ladies and gentlemen, give them the total value of any organization using the PE ratio. I will take the PE ratio times something. I'll take the PE ratio times something. What is this times something? What is this times something? Is there somebody who is able to remember? Times earnings of the firm. Times earnings of the firm. Lynette, again, were it not for the fact that the month is quite at some funny corner, again, you would have gotten what here? A present. You would have gotten a present. You'd have gotten a present. Even the Lima, you guys would have gotten what here? My present. So ensure that towards the end of the month, you remind me. I owe you guys. I owe you guys. So in this case here, you can see it is P over E. This E is a denominator. When it comes to multiplying, for me to be left with the price alone, then it means that here, I must come and talk of what here the total earnings of the entity that is being valued. They've told us that the price earnings ratio that they want us to use is 8 times. PE ratio is 8 times. Times the earnings of a Tiny. It's forward looking, so it's future earnings. They've told you in their question, the offer price for Tiny Limited, if Huge Limited were to value Tiny Limited on a forward means futuristic, on a forward price earnings multiple of 8 times. So then the forward PE is 8. How about the forward earnings, the future earnings, the forecasted earnings of Tiny Limited? Were given these in paragraph number 1. In paragraph number 1, Huge Limited intends to take over Tiny Limited, another company in the same industry. Tiny Limited is expected to post earnings of 86 million. So we have here 8 times 86 million. So could you kindly give me this multiple very fast? So they are giving me a figure of 86 million. Thank you very much, which is the earnings of Tiny Limited. So if there's somebody who can give me, Omar tells me 688 million. So this 688 million is the value of Tiny. So this basically will be the offer price. This is what we are offering. Remember, the question was, number 1, you give us the offer price for Tiny Limited. If Huge Limited were to value Tiny Limited, offer price is the same as the market value of an entity. This we are done in our last class. If my memory serves me right, we are supposed to be in number 2, where they want us to give them the WACC for Huge Limited after acquisition of Tiny Limited. So they want me to give them the WACC. And this is what I was telling in our last class, that there are some people who are very unprofessional. There are people in this case, even after, for example, they are appointed to be the finance directors of their circles, finance directors of their big companies. You'll get somebody, instead of pronouncing this thing professionally as WACC, you'll get somebody calling it Wakaka. No. That's very unprofessional. It's supposed to be WACC. It's supposed to be WACC, yes. So on this WACC, what do? We normally take weight of equity, cost of equity, multiplied by weight of debt, cost of debt. But now remember that cost of debt is tax allowable. Cost of debt, you must always subtract tax. Cost of debt, you must always subtract tax. Remember, when you talk of WE, this is the weight of equity. This is the weight of equity. When we talk of WD, WD is the weight of debt. The weight of debt. The weight of debt. The weight of debt. When we talk of KE, KE is the cost of equity. Cost of equity. When we talk of KD, this is the cost of debt. This is the cost of debt. And then, of course, lastly, when we talk of this T, T is the tax rate. T is the tax rate, which in this question has been provided to us up there before required. Before required, there must be a place where they told us, second last paragraph, the tax payable is 30%. Tax payable is 30%. They told us that. They always tell you about tax. If they don't tell you, you don't assume. If in finance, they don't tell us what the tax is, we don't assume. It will always be zero. If they tell us it's 30%, then we know that 1 minus tax will be 1 minus this 0.3, which will give me 0. What there, which will give me 0.7 like that, which will give me 0.7 like that. So I'm trying to get what we call the low-hanging fruits. Low-hanging fruits are those great fruits that come from where? From Ukambani, right? Great fruits, right? You don't need a lot of energy to harvest them. You can actually even just stay beneath a tree, and then you can even scream a little bit, and then those mangoes come down, very sweet mangoes, right? So I'm trying to get low-hanging fruits here. I'm trying to get low-hanging fruits. Now, ladies and gentlemen, where do we get these weights from? Because now here, the big thing will be the weights and the cost of equity. Great. Now, please go to the last paragraph. The last paragraph is so nice to me. They are telling me that if Huge Limited acquires Tiny Limited, it estimates that the gearing after the acquisition will be 35% measured as value of debt as a proportion of the total equity. Could you kindly underline for me the word gearing? Gearing has got every association with debt. Gearing and debt are one and the same. So whenever you hear of gearing ratio, this automatically is the same as what here? Weight of debt. You don't even have to reason at all. Gearing ratio is the same as weight of debt. Gearing ratio is the same as weight of debt. Very easy. Gearing ratio is the same as weight of who? Weight of debt. So gearing ratio, this is the same as weight of who? This is the same as weight of debt, which is 0.35. So if the weight of debt is 0.35, what do you think will be the value of the weight of equity? Hey, please wake up. Look at me nicely, right? If the weight of debt is 0.35, then the weight of equity will be 0.65. Thank you so much. Therefore, weight of equity will be 1 minus 0.35, which will be 0.65. I mean, the two are mutually exhaustive. The two, when you add the two, they must add up to what? They must always add up to 1. Once you tell me one component, getting the other component is as easy as a walk in the park. Those are the low-hanging fruits. I'm screaming below that tree, and I can see the fruits now coming down. I'm getting marks here. So I have the weight of debt. I have the weight of what here? Equity, like that. Now, ladies and gentlemen, there is something that in financial management, especially at this level, we can't give to you. If you come here thinking that that will be given to you the way it was being given to you in financial management at the intermediate level, then know that you're in trouble. For us here, we'll always hide this. This is our white card, the cost of equity. This one here will always be hidden. But ladies and gentlemen, it doesn't matter how they hide this. For me, I know getting cost of equity is a simple thing. getting cost of equity, I could either decide to use that dividend evaluation provincial officer model, if information is given. But in most cases, cost of equity in most cases is ascertained. In this case here, we shall ascertain it. We shall ascertain it using CAPEM. For the lovers of football, CAPEM is very important. So I shall ascertain it using CAPEM. What does CAPEM stand for in full? CAPEM, ladies and gentlemen, what this CAPEM stands for, this is capital assets, pricing model. Capital assets, pricing model. Capital assets, pricing model, a very important model. Capital assets pricing model is one of the ways that we should be using, ladies and gentlemen, here to get what we call cost of equity. Cost of equity, whenever you hear of cost of equity, the very first thing that I'll think about without even looking at other things will be this CAPEM. CAPEM is a great solver of cost of equity, but now from your intermediate financial management level, is there somebody who is able to remember the CAPEM's formula? Is there anybody who is able to remember the CAPEM's formula? Is there anybody who is able to remember the CAPEM's formula from your intermediate level? From your intermediate level, CAPEM formula. CAPEM is quite a nice word. It's quite a nice name. If I was still getting kids today, I would have called my last born what year? CAPEM. But unfortunately, before I got to know this subject, I'd finished those things of getting kids. Great. So they are telling me that Mwalimu, we may forget about everything else, but there is something we'll never forget out of what we did in the FM, the foundations, not foundations, but at intermediate level, we have what we call CAPEM, cost of equity. CAPEM must start from the lowest. So we must start from what we call the risk-free rate of return, plus what we call expected returns of the market, minus risk-free. This is what we call the premium. Listen, ladies and gentlemen, when I'm told to make an investment under CAPEM environment, I'll be given two types of securities. I'll be given the risk-free security, and I'll be given the market security. If I go for the risk-free security, then of course the returns will be smaller, but the good thing is that we don't have any risk with them. But when you go for the market securities, then you're going to get, as Sharon tells us there, market security will always give you a premium. But you see that premium normally comes at what year? At a risk. So this is what we call a premium. And then we need to come and multiply this with the risk factor called who? The beta factor. Remember, in finance, the higher the risk, the higher the returns. But now remember, it's a balancing act. At times, in this case, the risk will outweigh everything else. And of course, it kills the entire business. Like I'm so sure in this room, there must be somebody in this case here who went for this business of rearing who? Quails. At one time, in this case, the returns of quails were up there. But of course, the risk came from behind and it was able to, in this case here, it overtook the returns, and the people in this case here cried quite a lot, right? So the most important thing that is supposed to appreciate here is that whenever you go for the market premium, then we expect in this case here, there to be a risk, For now, what I would want you to do is to cram this. Please go there and highlight this. When we talk about RF is the risk-free. This is the risk-free rate of return. This is the risk-free rate of return. This is the risk-free rate of return. And then we have ERM. ERM is the market return. Let's call it market return. Just call it market return. And then we have, in this case here, BS. BS is beta of a security. Beta of a security. So beta of a security for now, I would simply want you to appreciate that beta of a security stands for the systematic risk. So beta is a measure of systematic risk. You can even mention there that beta is a measure of systematic, who is a measure of systematic risk. Don't worry about systematic risk. For now, the thing that I would want you to cram here is that CAPM, cost of equity, will always be equal to risk-free plus ERM minus this risk-free to be able to get the risk premium. And once I have the risk premium, then the risk premium must always be multiplied with the beta of a security, So then let us use this acquired knowledge to be able to calculate the CAPM, cost of equity in this case, using the information given in paragraph number, in the last paragraph. So in the last paragraph, what are they telling us? If Huge Limited acquires Tiny Limited, it estimates that the gearing after acquisition will be 35%, measured as the value of debt as a proportion of the total equity and the debt. After the acquisition of Tiny Limited, Huge Limited would have a cost of debt of 7.4% before tax and a beta of 1.6. I can see beta there. Beta has been provided, 1.6. Beta is 1.6. The risk-free is 6%, and the return on the market portfolio, is 11%. Using the last sentence, I would want to see whether there is anybody here who will be able to give me the CAPM cost of equity. Using the last sentence, is there anybody here who will be able to give me the CAPM cost of equity? I want to show you something that will make you guys pass this thing in round one. So Gordon tells me 14%. Is there Lynette is also getting 0.14, which is the same as what here, 14%, So the most important thing here is that these guys have already given us the risk-free rate of return. These guys have given us the risk-free rate of return. He has given us the risk-free rate of return in the last sentence. The risk-free rate of return is 6%. So 6% plus, they have also given me the market return. They have told me that the market return is 11%, minus this 6% multiplied by beta, which was 1.6. So here you have to be very careful with body mass. Here you must be very careful with body mass. If I were you, first of all, I would start with what we have in brackets. 11 minus 6 is 5%. So 5 times 1.6, I get that figure. I think it's 8 or something, 8 years. So once I get 8%, then I'll add 8 to 6, which will end up giving me 14%. I can also divide to have this in form of decimals. So I'm being told that this is 14%. This is 14%. I'm being told that this is 14%. This is 14%. Great. Thank you so much. Ladies and gentlemen, please come here. It's not lost on us really on what you're supposed to do in this question. What you're supposed to do in this question is to get the famous ACCA. So ACCA, in this case here, we know that it is weight of equity, cost of equity, plus weight of debt, cost of debt. But now this has to be adjusted for tax. This has to be adjusted for taxation. So I want to give you guys exactly 1 minute. Exactly 1 minute. Could you kindly try to plug in the figures here, and then you give me the famous ACCA. You give me the famous ACCA. Try to plug in the figures. Now I think we've got everything. Now you've got everything. You don't need to fear anybody. Don't fear nobody here. You go ahead and put in your figures. Whatever answer you get, please just present the answer there for us. Tell us the answer there. Tell us the answer there. So I can see I've got very many new students around. If you're interested in joining us, please don't even think about joining us twice. Simply hit this number, make enquiries, and join us. Make enquiries and join us as early as today. 0719 525 1000. I can't see anybody who has been able to plug in the figures and given us any figure really for ACCA. Remember now you have got everything. Yours is simply to come and plug in the figures. Yours is to plug in the figures. Yours is to plug in the figures. CC. We have Cliff. Please, I would expect to see your answer. You guys have got great names. Brenda Osanya, Ben Richard. I expect to see your answers. I expect to see your answers. We have Elizabeth Amisi, Elizabeth Ndunga. We need your answers for WACC. What do we have there? Somebody, what do we have there for WACC? So let me remind you. Is there somebody who can remind us the value of weight of equity? 10.91. Okay. So what is the weight of equity? You guys had given me a figure of 0.65. Cost of equity is 14%. Weight of debt was 0.35. Cost of debt has been provided to us in this last paragraph. In the last paragraph, they've given us a cost of debt of 7.4% before tax. So this is 7.4% before tax. It means I must come and multiply and adjust it for tax by multiplying this 7.4 with 0.7 that we got earlier on. 0.7 we had gotten earlier on, earlier mapema kabisa. All right. So I can see from Elizabeth there, we are getting 10.913. Remember, as I'm multiplying, I can even forget the percentages. I can leave the percentages out. So we have 0.65 times 14 plus 0.35 times 7.4 times 0.7, which at the end of the day will give us a what figure? They're telling me it is 10.9. It's 10.913. It's 10.913%. Now you can turn that percentage and then you mark for yourself. Some of these answers, when you get them so nicely, don't forget in this case here, putting an emoji for the examiner, a smiling emoji. Smile for the examiner nicely like that. The examiner will feel so nice. Even these guys, we know that they're quite bored. They would want somebody in this case here who smiles right back at them like that. So Roman 2, they wanted us to give them WACC. That we have perfectly done. Is there anybody who has a question? Because if there is no question, I would want to go to the next question myself. So if there is no question, in the absence of a question, I would want to go to Roman 3, where they want me to give them the offer price for Tiny Limited using a discounted cash flow method. I love this. So they would want me to get cash flows and then we discount. This is an examiner who loves me. This is an examiner who is wishing me success. This is an examiner who is greeting me with a golden handshake. This must be a golden handshake. A golden handshake. A good question here. For Wakaka, will I have to always find CAPM? In most cases, not 100%. There is also another formula that will be teaching you of getting cost of equity, but in most, talk of 80%. 80% of the Wakaka questions would want you to remember the CAPM equation. Let me ask you a question. Now, are you able, did you study CAPM in financial management of the intermediate level? Did you study this? CAPM at the intermediate level, financial management. CAPM, no. You guys are cheating. It is there. You guys are cheating. Thanks, Liz. Liz has been able to at least give us the main meaning of the acronym WACACA. It is the weighted average cost of capital. It's the average, you know, like how the capital structure of a firm looks like. We have equity, we have debt, we have preference shares. So if you take the cost of equity, the cost of debt, and then you find an average, whatever average you get there is known as what your weighted average cost of capital, which is your WACACA. Liz says yes, but many years ago. Isaac says they did this in Campus 12 years ago. Do you want to tell me that, Manoti, you are that old? Manoti, I doubt. Are you that old? 12 years. The photo that I saw the other day of Mr. Manoti doesn't really look like somebody who did his BCom or whichever degree. over 12 years. No. You guys are cheating. You guys are cheating. 14 years. No worries. The most important thing you're supposed to do here is to come and at times cram. You have to cram at times. We can't really go back and we start looking at so many things. We are saying that there is a very important rabbit here. Rabbit called who? Called the CAPEM. And for us to get this CAPEM cost of equity, what do we do? We shall be taking the risk-free, the bottom line, the benchmark is risk-free, plus what we shall be calling expected return of the market minus risk-free. And then we come here and multiply this with what here beta of the security given, or beta equity, as we shall see when we advance in this subject. 2014, I shall overcome. Miaka inasonga, miaka inasonga, miaka inasonga, miaka inasonga. I'm the only one who is remaining young forever. So we shall overcome. So they want us to give them, ladies and gentlemen, they want us to give them the cash flows of the entity. So how do we get cash flows? It's very easy. Cash flows are quite related to profits. And from your section 1, intermediate, not intermediate, but foundations level, quantitative analysis, you guys learned something very important. That to get profit, we normally take revenue minus cost. Revenue minus cost. Are you able to remember this thing? This one, everybody remembers this. Profit equals revenue minus who? Cost. This is very important, yes. Thank you very much. So that's what we shall do. So we are given some table there. You can see we are given in this second paragraph. They've told us if Huge Limited acquires Tiny Limited, the expected results of Tiny Limited for the next years will be as follows. So we have sales, we have cash cost stroke expenses, we have capital allowance. So for us, in finance, whenever you see capital allowance, what should come to your mind? For us, capital allowance is depreciation. Whenever you see capital allowance, simply go there and write in brackets, depreciation. We are learning something very important here. We are saying that capital allowance will always be equal to who in finance, will always be equal to depreciation. Very, very important. Thank you very much. Will always be equal to depreciation like that. Great. Next paragraph. From year 4 onwards, it is expected that the annual cash flows from Tiny Limited will increase by 4% each year into perpetuity. So when you hear that language of perpetuity, what comes to your mind? When you hear that language, you as a finance scholar, what will come to your mind? PO, perpetuity. When they talk of perpetuity, there is something that will always come to my mind. PO. Perpetuity, provincial officer, district officer, who has to grow, blah, 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 blah. Thank you so much. Thank you so much. Now, ladies and gentlemen, then they are telling us something very nice. Or rather, could we kindly go ahead and now look for these profits? Let's draw this table ourselves. So we have year 1. Let's draw this table ourselves. So we have year 1, we have year 2, we have year 3. I want the profitability of this company over the 3 years. So we are going to start with sales. Sales is revenue. So we have sales here. We have sales there. So we have sales. So are you able to see the sales figure? Are you able to see our sales figure? Are you able to see our sales figures? For year 1, sales is 200. I want my figures to be in millions. So year 1 sales is 200. Year 2 sales is 280. Year 3 sales is 320. From there, I can see expenses C. Expenses C, I can see 120. I can see 160, my figures are in millions. I can see 180. Expenses C are to be deducted like that. And then I can see my capital allowance C, that is depreciation. Depreciation, ladies and gentlemen, is my capital allowance. I don't like using the word capital allowance. So depreciation, I can see 20, or I can see 30, I can see 40. It's a deductible item. I deduct like that. And then I can see interest. I can see interest charge. I can see 10, like that. And that is it. So could you kindly come here and then you give us, could you kindly come here and then you give us profit before tax. You give us profit before tax. PBT. Give us profit before taxation. Give us profit before taxation. Oh. Are you able now to hear me? You guys, are you able to hear me? Sorry, I'm being told I'm frozen. I can't see what you're doing. Only sound is on. Okay. Sorry for that. Let's take like a minute break for us to be able. But now they're saying everything is okay. It was just a flash of a second. Great. It's okay now. Thank you very much. So then could you kindly give me this profit before tax? Give me the profit before tax. Give me the profit before tax. Give me the profit before tax. So year number 1, according to John Modiani, is 50. Year number 1 is 50. Year number 2 is 80. Year number 3 is 90. But there is something in this semester that so many students in this case here picked up. They picked up this thing which made them, in this case here, detour, which made them to detour from the road going up directly to passing CASNEB exams, something that they picked. Most of them came and picked that cash to replace assets and finance growth. Assets being acquired can never go to the income statement. Assets being acquired, that's a balance sheet, that's a capital expenditure. This cash to replace assets and finance growth can never be deducted while arriving at profitability. Can never. That is what we call CapEx. It's a capital expenditure. It will go to the balance sheet. It can't go to the income statement. It can't go to the income statement. It can't go to the income statement. So this is profit before tax. Once we get profit before tax, we shall go ahead right away and less tax. So go ahead right away and less tax. Have they given us the rate of tax? Oh, yes. They have told us tax is 30%. Tax is 30%. They've told us tax is 30%. So could you kindly subtract and rather give me 30% of this figure? 30% of 50. 30% of 50. This gives me 15. 30% of 80. 30% of 80. Joyce Buki, I've never heard you talk to me. I don't know why. Niliwakosea wapi. Wengi hapa waniongeleshangi kama Masi Nyakio, kama Agnes, awaniongeleshi. We shall overcome. At Alicia's, we shall overcome. At Alicia's, we shall overcome. We shall overcome. We shall overcome. We shall overcome. Okay, so year 3 is 27, like that. So you subtract like that. When you subtract like that, then you'll be able to get what we call profit after tax. Profit after tax. Is there somebody who can give me this profits very first? Paul Macau. Aha, so we have 35. Thank you so much. How about year number 2? How about year number 256? I'm being told. How about year number 3? 63 by Lynette. Thank you so much. So remember that we are looking for cash flows. Profits is just obiter dicta, by the way. After I get profits, there is some abracadabra I have to do to change the profit after tax to cash flow. Who is able to remember this abracadabra? What am I going to do to be able to change profit after tax to cash flow? What am I supposed to do? We add back depreciation. We add back depreciation. That's how you write it. Profit after tax, to change profit after tax to cash flow, you add back depreciation. add back depreciation. So depreciation, hapa ni 20, hapa ni 30, hapa ni 40. You add back depreciation for you to be able to get our cash flows, operational cash flows. You add back depreciation for you to be able to get the cash flows, So yes, it's very okay to use the interest tax shield instead of adding back. But for me, I'm the old school type. I'll always prefer adding back depreciation. In all my workings, I'll always prefer adding back depreciation because of, in section 5, in this advanced level, these guys will be telling you that this tax is paid in arrears, right? Yes, because depreciation is not a cash flow, yet it was deducted, yes. That is the reason, yes. We are adding back depreciation because, as this lady is telling us, you subtracted it here, right? For purpose of getting the taxable profit. But later on, you realize that, hey, because you want cash flow, then I would rather add this depreciation back. So I'm being given a figure of 55. Then we have 86. And then we have 10 what here? 103. Now, these are the operational. Please write there up. Right there, operational cash flows. Sasa nataka munisikize na munisikize vizuri. Unapopata hizi operational cash flows, unatenga pesa. Kisiasa nasema kutenga mabilioni. Unatenga pesa. Kama kuna pesa ambayo unaambiwa zinahitajika kuja kununua hizi fixed assets, unazitenga, unaziweka kando. They can never be part of our cash flows. Tutenge hizi pesa, kama hapa wametuambia namna gani. In this particular table, they have told us that we need cash to replace assets. So cash to replace assets must always be deducted from the operational cash flows. So mention there, less capex. Capex is what here is capital expenditure. Cash for replacing fixed assets. So we less capex, and the capex that you're seeing here is 25. Capex you're seeing here is 25. We have 30, and then lastly, we have 35. We have 35 like that. So you come and subtract this, you unatenga. Ukisikia unaambiwa kuna cash, which is needed to buy some fixed assets, always hiyo lazima inatengwa, right? Adjust the board to see the whole board, okay. Sorry for that. From my side, I'm able to see the whole of it. I don't know why you guys can't see the whole of it, really. From my side, I'm able to see the whole of it. Okay, I hope now that's much better. Okay, what's CAPEX? Thank you very much. CAPEX is the capital expenditure. The expenditure which you will need to incur to replace assets. Thank you so much. So could you then kindly give me this? Now we shall call this one the free cash flow. We shall call this one the free cash flow. The free cash flow. Hii dunia iko na maneno, mtaipenda sana. Mara kwanza tukifanya, unaona kama ni mzito, lakini sio mzito. So please give me these free cash flows. What do we have here? We have from Willie Velma, from Godonware, Joyce Buki, 25. No. 30, 56, and then we have here 103 minus 35. 103 minus 35 gives me 60 what here? 68. Now, could you kindly double underline these figures? Please double underline them. Lasa ukuje usimamishe na useme year 1, year 2, year 3 na kuna infinity. Sasa hapo weke free cash flows are the ones we use for valuation purposes. For valuing target companies, we shall be using free cash flows. So we have 30, 56, and then we have 68. And then these guys have given us growth rate into perpetuity. They've given us growth rate into perpetuity. Oh yeah, abracadabra. If you read the first paragraph after the table, the first paragraph, from year 4 onwards, it is expected that the annual cash flows from Tiny Limited will increase by 4% each year into perpetuity. So growth rate here is 4% into perpetuity. So I would want somebody to come and give me this figure now. Somebody please try for a small gift, for a very small gift. Could you kindly try giving us this figure of cash flow of perpetuity for a very small gift? For a very small gift. Let's see, you'll be able to get my gift tonight. Give me the figure of, give me the figure of the infinity cash flow for a very small gift. And remember, my gift will be surprised. My gift will exceed your expectation. My gift will exceed your expectation. My gift will exceed your expectation. It shall be something nice. Something that will make you see places that you've never seen before. Places that you've never seen before. Thank you so much. I'm getting answers that are quite different. So now we stop there. Now, even if you get correct, no gift. Let's stop there. Now you're no longer looking at the answer ya mwisho ilipewa na Manoti. Answer ya mwisho ilipewa na Mr. Manoti. Hiyo ndio answer ya mwisho. So kumbukeni hapa, hii ya infinity ni PO. And for us to get the PO, ladies and gentlemen, always it is district officer into 1 plus growth rate all over KE minus growth. But again, remember, this is for purposes of you cramming. Otherwise, we should always know that this KE is always the COC. The cost of capital is always the cost of capital. Which cost of capital do we have? We have our WACCA, our weighted average cost of capital. I'm so sure so many of us lost it there. That's where in this case here, as I always say, keep your eyes on the ball. But at times, of course, the ball could behave in a funny way and it disappears from your sight. Especially if the opponent is a strong player like Messi, right? They can come and do like this, and then you can't see the ball at all, right? So here, always remember it is cost of capital. So the most current dividend is this, 68. 1 plus the perpetual growth rate is this, 0.04. All over the WACC, you guys did give me the WACC. If my memory serves me well, it was coming to 1093. So 0.1093 minus the growth rate again, which is 0.04. So here you have to go very slowly. First of all, give me the numerator. 68 times 1.04. Numerator, give me the numerator alone. 68 times 1.04. What figure are we getting? Depreciation of 70.72. How about the denominator now? John, I'll answer your question right now. But first of all, let's clear this question. Denominator, is there somebody who can see the denominator? According to Devi, 0.06913. 0.06913 like this. This is so important to me. Now I need to come and get the quotient. So is there somebody who can give us the quotient? Here? We divide now. So they're telling me the answer is supposed to be 1022. KE, very good questions there. 1023. CAPEM KE was 14%. 1023. If you used 11%, you got 1010. 1024, 1023, one and the same. So I'll only pick one. So here we have 10. What here? We have 1023. Don't want decimals. I don't want decimals. Now, students here are coming up with something. 1093 imetoka wapi? Kumbuka WACC, nilikuwa nimecalculate WACC kwanza. Nakumbuka Ross WACC. What was the WACC? What was the figure of WACC? Please remind me. I may be wrong. What was the WACC figure? What was the WACC figure? Leave around the KE. 10, 9, 13. Oh, 10, 9, 13. So then this one should be 10, 0.10913. Will we still get the same answer really? Will the answer be the same? Will the answer be the same? I'm so sure some of you used here 11%, like Monsieur K, the lady, used 11%. That is why she was able to get 10, 10, 10. The answer came to 10, 10. Great, great. Thank you very much. Now, please, I would want you guys to listen and listen to me very carefully. You know, when it comes to valuation of shares, we strictly use KE here. But valuation of organizations, I would want to repeat this. Valuation of organizations, our organization here has got both a debt and what equity. When you are valuing an organization, I would want to make this very clear. Whenever you are valuing an organization, this can't be a KE. This shall always be WACC. I'll use Kenya minus government. I'll use cost of equity minus government because that is easier to remember. But again, remember, for purposes of valuing an entity, we shall always use what they are, WACC. How I wish all of us were speaking the same mother tongue language. I would have written or rather pronounced everything there that I've said in one mother tongue, and all of us would have copied and understood it very well. So what have we said? We've said, and now you're writing this in your mother tongue. Unfortunately, you guys don't know your mother tongues. If, for example, I was to tell you guys to even tell me what Wakaka stands for in your home, local dialect, nobody here knows. I'm the only one who knows what Wakaka is in my mother tongue. For company valuation, down here, we shall always use what here, weighted average cost of capital. Weighted average cost of capital. Great. So explain 68 as our DO. Remember, DO is the most current dividend. Most current dividend is this one here, 68. This is the most current dividend that I shall use to value this. Most current dividend is 68. Thank you for asking those questions. Thank you for asking those questions. I'll come back to John Modiani's question in a moment. But now, are we in agreement with this 10.3? Are we in agreement with the 10.3? Are we in agreement with the 10.3? Yes. Thank you very much. And then now what we shall do, the last step, is that you will come and create a column here for PVIF. Create a column up here for PVIF. Create a column up here for PVIF. Present value interest factor, which is 1 plus R raised to negative N. So PVIF here will be 1 plus 0.10, 913 raised to minus 1, 1 plus 0.10, 913 raised to minus 2, 1 plus 0.10, 913 raised to minus 3. So could you kindly give us these answers in 4 decimal places? In 4 decimal places. In 4 decimal. Irene is asking, when do you use KE? When we go to this topic called financing decisions, when they tell you to value a share, get PO, what is the value of an ordinary share? Then you shall be using KE. Thank you very much for that nice question. Abracadabra, Isaac Obae. Is it Obae or Obare? It must be Obare. So Isaac amesema ni 1991. Isaac, wewe sasa umetumia ile ya kitambo. Umeenda ukasoma ile ya kitambo hapa, hiyo ndio ukweli wewe Isaac. Huwa zina vitu zina change. Umeshinda kuongea Kiluya. Lakini vitu zinabadilika. Hii 1991 mimi najua ni 10% Isaac. Kwa hiyo umeenda ukasoma mahali. Again, rate we use, yes, the rate we use W for valuation of farms everywhere. The rate is WACC. The rate is WACC, yes. The rate is WACC. Everything here. The rate is WACC. The rate is WACC. Thank you for asking that. So nimeshaambiwa ya kwanza na David Yes, imenishinda kupronounce kidogo, but we shall overcome. We shall overcome. So 9016. So 0.9016. Now I have to adjust my board. Tuende hapa jameni kwa ya pili. Ya pili ni ngapi? Ya pili sasa unasema 1 plus 0.10913 equals raised to negative 2. Naambiwa na Miss Mosioka 0.8129. 0.8129, 0.8129, 0.8129, 0.8129, 0.8129. Kutoka hapo sasa unda kwa year number 3. Kwa year number 3, kama kuna siku mmenifurahisha leo, wenyewe mmekuwa hata kama topic ni a little bit heavy, leo mmekuwa very aggressive. Mmekuwa very aggressive. 7329. 7329. So 7329, hebu naulizeni swali, what PV figure will I use for this infinity? What PV figure will I use for this infinity? What PV figure will I use for this infinity? Aha, thank you very much. Thank you very much. Drop down. This 7329. Abracadabra 7329. So kuja hapa create column ya mwisho ya present value. Create column ya mwisho ya present value. Create column ya mwisho ya present value. So create column ya mwisho ya present value. Create column ya mwisho ya present value. So what do we have here? Present value. Present value is a round off. Present value is a round off. You don't attack at 2 decimal places. Present value inanga diambo. Unaweza round off. Unaweza round off present value. Aha, so David Kashero gives me the first one as 27.05. 27.05. 27.05. That is the first figure. 27.05. How comes it's only one person who has gotten this figure really? Remember, it is this figure cash flow times the PV. Those two, you're multiplying them. 27.05. And then now we have 45.52. 45.52. And then now we go to number 3, the third one. The second one I'm being told is 49. I don't know who is now telling me the truth. I don't know who is telling me the truth. According to Mrs. Mosioka Elizabeth, it seems this 49.84 ya ukweli. Wamesema ni third. Sasa hapo sininoma, mmeconfuse mimi sana. 49 is the third one. 49.84 is the third one. Thank you. How about in this case here, infinity? How about infinity? So infinity 93.7329 inakuja ngapi? Abracadabra, we have 749.76. 749.76. So could you kindly come and add for us? Give us the total present value, which will be the same as the farm value. Farm value using discounted cash flow method. Farm value using discounted cash flow method. So farm value, according to Paul Macao, is supposed to be 862. Mosan Matara anasema ni 872. So I don't know who is telling me the truth. 872 carries a day. 872 carries a day. 872 million. 872 million. 872 million. 872 million. 872 million. 872 million. Yes, that is a farm value. So I can't pay more than that. That is a farm value. That is a farm value. I can't pay more than that. I can't pay more than that. Now, I would want to repeat a few things. Like I remember what John Mudhiani asked me. He asked me a very good question. Let me wrap the board now. Let me wrap the board. Life is good. Life is good. Life is good. Life is good. So I remember it's only one student who got that 10-10-10, who is Miss Mosioka. But Miss Mosioka siwezi kumpea zawadi. Miss Mosioka ametoka majuzi. Akona pesa mingi, akona madola. Akona madola bado. Huyu akona madola bado. Huyu bado akona pesa mingi sana. Sasa nataka kidogo tuangalie hapa. Now, ladies and gentlemen, if, for example, you are given this, if, for example, you are given this, if, for example, you are given profit, these are basically exercises to help you. You're given profit before depreciation and tax of, say, 10, and then they give you depreciation of, say, 3, and then tax is 30%. Could you kindly give me the cash flow? Could you kindly give me the cash flow there? Good question. They have given us profit before depreciation and tax of how much? Of 10. Depreciation is 3. Tax is 30%. Then they want us to give them cash flow. We shall overcome. I hope Musawa has seen your comment. Paul, I hope Madam Musioka has seen your comment. Great. So solution. So what I'll do, because they want me to get cash flow, I have to endeavor to get profit after tax. The first thing I need to do is to get profit after tax. So then how do we do this? So it is profit before depreciation and tax of 10. We say less depreciation of 3, which will end up giving me 7. What name do we give to this 7? It's simply depreciation that has been removed here. So this will be profit before tax, which is 7. So please go ahead and tax. Tax is 30%. 30% of 7 is 2.1. So could you kindly subtract? What is 7 minus 2.1? 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 Somebody, 4.9. So this 4.9 is what we can call profit after who? Profit after tax. So profit after tax is 4.9. Once I get profit after tax, I need to change now this straight away to cash flow. And how do I do this? I'll come and add back. You add back depreciation. You add back depreciation of 3. So 4.9 plus 3 gives me 7.9, which is what here? Which is our cash flow. So our cash flow per annum will be 7.9. 7.9. And of course, some other student, like the one who was asking me the question of a tax shield, some other student will have opted to get the cash flow direct. Quite a very good method. Although I don't like it because it's not applicable 100% all the time. Some other student would have come and said that cash flow equals profit before depreciation and tax. And then you go ahead and tax this without subtracting depreciation. But now remember, later on, they will come and enjoy some tax shield. So you come and add what we call the depreciation tax shield. Depreciation tax shield. So, ladies and gentlemen, this profit before depreciation and tax is what we already have as 10, right? Times 1 minus 30%. Tax is 30%. 30% is the same as 0.3. So 1 minus 0.3, 1 minus 0.3, ladies and gentlemen, is 0.7. So 10 times 0.7 plus depreciation itself, which is 3, times the rate of tax. Rate of tax is how much here? Is 0.3. So could you kindly move slowly and give me the cash flow using this method 2? Using this method 2, could you kindly come and give me, using method 2, kindly come and give me the cash flow. Give me the cash flow. Of course, you'll bear witness with us that the cash flow still there will be 7 point what here? Will be 7.9. Will be 7.9. Thank you. They haven't, most of them confirmed 7.9. Thank you so much. Now, ladies and gentlemen, please, I would want you to try this as second exercise. Very important exercise for me. Very important exercise for me. What if the profit before depreciation and tax was 15, but depreciation was higher, 20? Tax is 30%. Could you kindly give me the cash flow here now? Could you kindly give me the cash flow here now? So exercise 2. They have given you profit before depreciation and tax of 15. Depreciation here is 20, which is higher than the profit. Tax is 30%. And then they want you to give us the cash flow. They want you to give us the cash flow. They want you to give us the cash flow. They want you to give us the cash flow. Is there anybody who has an answer already? Please remember, this is a subject which basically wants you to do two things. Number one, you like your teacher. And then number two, you like the subject. Just those two things. So David Cachero tells me 16.5. 16.5. Aha, Paul Manotti gets 16.5 as well. I suppose these guys have used method 2. That's why they are able to give us answers with quite a high speed. They've used method 2. I know they've used method 2. I want to know whether there is anybody who has used method 1. I would want to know whether there is anybody who has made use of method 1, who has made use of method 1 and gotten that 16.5 and gotten that 16.5. Do we have anybody? Tobias Obuago, 16.5. Thank you so much. Thank you so much. 16.5, 16.5. Great. Oh, kumbe you are a nurse. Great. Save a life. We shall overcome. Good to know that there are people who have diversified. Great. 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 So we come back here. So solution. So we have our profit before tax of 15. We less depreciation of 20. So they subtract 15 minus 20. This gives me minus 5. So this is profit before tax. Then we shall come and less tax. Tax at 30%. 30% of minus 5. Remember, for us, we don't make those kind of argument that these are laws, you don't pay tax. Who told you like that? For finance, you must tax. For finance, you must tax. So 30% of negative 5 is what here is negative 1.5. But now remember, you are taking this minus this. So this is going to be subtracted. If you do that, then you'll be able to give us what we call profit after who? Profit after tax. So then profit after tax here will be minus 5, minus for the bracket, and then minus 1.5. So minus 5, minus 1.5. What are we able to get at the end of the day, ladies and gentlemen? So David tells me minus 3.5. I can't work with one student's answer only. That's quite risky for me. That's quite risky for me. Minus 3.5, because we have minus 5, minus. So this gives me minus 3.5. Thank you so much. Minus 3.5. And then we shall come and add back depreciation. So we add back depreciation of how much here? Of 20. That is how these gentlemen were able to get the 16.5 as the cash flow. You can also decide to use method number 2. So what are we learning out of this? That regardless, it doesn't matter whether we are in a loss region. For us in finance, we must always do what here? We must always subject our figures, even if they are negative. We must always subject them to what here? To taxation. We must always tax them. So, and don't forget, ladies and gentlemen, that method 2, just in case you would wish to use method 2, that you could have also decided to say that cash flow equals profit before depreciation tax into 1 minus tax plus depreciation tax shield, like that. So, ladies and gentlemen, here we have this one here is 15 times 1 minus tax is 0.7. Depreciation is 20 times tax itself, which is 0.3, times tax itself, which is 0.3, So then in that case, you'll be able to get that answer. You'll be able to get that answer. Do you still call it profit after tax? Good questions. Even if it's a negative. Remember, Agnes, the worst mistake you can ever do is, for example, when somebody asks you like, what was the loss of Kenya Airways last year? And then you go and say, Kenya Airways made a loss of negative 10. You know, when you call it a loss, then you can't put a negative. But you see, when you say Kenya Airways made a profit of negative, so you see, when you're using the language of profit, the negative comes in. So even if it's a negative, you must be consistent. Still make use of what your profit after tax. I hope, Agnes, that is clear. So you don't change because the sign is negative. No, we don't change like that. You still call it profit after tax. Thank you very much. You still call it profit after tax like that. Thank you very much. So I hope this now is an agreement. Now, please, let's get our past paper. Let's get our past paper. We get our past papers. Great. May 2019. May 2019, question number 5B. May 2019, question number 5. Boy. 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 Question number 5. Boy. Please, once you get it, give me a thumbs up. Once you get the question, give me a thumbs up. Once you get the question, give me a thumbs up. And it's my belief that all the students that we invited here to attend this class are going to make a conscious decision to join us. To join us, yeah. To join us. Of course, they must have seen that I'm quite tough in teaching. You see, this is a paper that needs like that. Sort of a paper that I should really, be massaging you around here. I have to up the game. Because of what here, the limited number of people they can allow to pass these papers at a time. We normally restrict quite a lot. Quite a lot. You must work very hard for you to get what here, a pass. Great. So at least 2 students have confirmed, Masi and Omar. They have confirmed that they have gotten the question, May 2019, question number 5B. What about the other students? What about the other students? Have they gotten the question? Yes, John confirmed. Willie Velma confirms yes. So we are told here, Excellent Limited is considering acquiring Best Limited, a firm in the same industry, in order to consolidate its market share. Best Limited has been very less profitable, so it has paid an average of only 20% in taxes during the last several years. In addition, it has used little debt, having a debt ratio of 25%. Moffat will have to join. Thank you, Moffat. 25%. If the acquisition would be implemented, Excellent Limited could operate Best Limited as a separate, wholly owned subsidiary. This will increase Excellent Limited's gearing ratio to 40%. The following is a forecasted financial data. Yes, the following is a forecasted financial data for Best Limited over the next 5 years. So I can see sales, I can see operating cost, I can see selling and administration, except, so I'll subtract, I'll take 50 minus 5 minus 10 to get profit. And then you can see the other one, which can easily confuse you. Acceptable investment project costs. Don't expense that in the income statement. That is what we call a capital expenditure. Investment amounts cannot go to the income statement. I'll be using this investment amount when I'm calculating the free cash flow. So they're telling me that the risk-free rate of return is 8%, and debt is considered to be risk-free. Expected return of the market portfolio is 13. So when you hear these guys giving you risk-free, they are talking of market portfolio, what comes to your mind? What comes to your mind when you start hearing that language, you as an advanced financial management student? When you hear risk-free, you're hearing, it's CAPM, cost of equity. Thank you so much. You guys are brilliant. Thank you so much. Thank you so much. It is CAPM, cost of equity they want you to calculate. They have even gone ahead to give me equity there, beta. They have given me equity beta 0.8. After 5 years, the net cash flows of Best Limited shall increase at a constant rate of 6% per annum in perpetuity. I'm asking you this for the umpteenth time. This particular note, what should come to my mind when I read this concept of perpetuity? When I read this concept of perpetuity, PO, should be PO, should be PO. You guys are bright. You guys are bright. So the firm's gross profit margin is 40%. If gross profit margin is 40%, then the cost of sales will be 60%. I'm saying something very important. If gross profit margin is 40%, then the cost of sales percentage is 60, because the two must always add up to 1. If gross profit margin is 40, then straight away we have, ladies and gentlemen, the cost of sales percentage being 60%. Best Limited incurs fixed financing cost of 2 million per annum. The firm's equity, shares, and the bonds are currently trading at par. That is noise. In AFM, we like making a lot of noise as examiners. Why? Because our objective is quite a bad objective. It's quite bad that we as examiners are here, the students are here, and we are at a tug of war, right? That for me as an examiner to win, I must see some of you going under the bus. It's quite unfortunate, but that is a reality. And then, of course, students here are also trying to pull and win over us by getting 100%. So, of course, as an examiner, at times I'll try, in this case here, to be creative and confuse some students. Quite a sad story, but now that is a reality. That's a reality. So, required, determine the maximum price payable to acquire Best Limited using the discounted cash flow method. Using the discounted cash flow method. Where do I start from? I've seen a table. I can see sales. I can see so many other things. That is where I will start from. I'll do a profitability analysis very fast. Great. So, ladies and gentlemen, in the interest of time, let's just do this very fast. Let's do this very fast. How I wish I would have, I could have given this to you. You do it as a class work, and then we mark here together. But you see the way things now stand, we don't have that time really. So I just have to do the question myself. Now, this was quite a tricky question. I like this examiner. This examiner was able, ladies and gentlemen, to throw his students, many of them, under the bus. Why? Because students knew exactly the question was to be quite an easy one, but now this guy decided to twist it a little bit. So we have net sales. I can call them sales here. So we have 50, we have 60, we have 75, we have 70, we have 65. The first thing that this guy did, which was quite a game changer negatively, was the introduction of the gross profit percentage. He gave us the gross profit margin, 40%. Very few students were able to know that then the cost of sale percentage will be 60. Very few students. Oh, Mayom, hey, this is quite sad. Very sad, Mayom. That must be a network issue. So cost of sales is 60. Fortunately, Mayom, we have recorded these sessions. Actually, recorded both of them. So first of all, let's agree, ladies and gentlemen, that when the gross profit margin is 40%, then the cost of sales will be 60%. That is the first thing you're supposed to know. Oh, Irene is saying that I'm breaking. Are you guys able to hear Mwalimu? Are you guys able to hear Mwalimu? Yes. So then could you kindly give me these figures very fast? 60% of 50 gives me what? 60% of 50 gives me what figure? 60% of 50 gives me what figure? 13. Abracadabra, 60% gives me 36. This I can't know. This I can't know. The third one I can't know. 60% of 75 gives me 36. No. Nope. 45, thank you very much. Yes. This I can know, 42. This I can't know. The last one, 39. Thank you so much. So subtract here. You are able to get gross profit if you wish. Gross profit if you wish to put it down. If you wish to just have it down, you will get gross profit. So this is 20, although you can do without it. 20. This will be 24. Please give me these figures very fast. 30, 36. 30, 36. Joyce, are you sure this is 36? Am I the one who is not dreaming because I must be very tired since 2 p.m.? Aha. Hebu kuja hapa. Kwanza niambie ni ngapi? Niambie kwanza ni ngapi? 60 minus 36 is 24. Hii itakuwa 30. Hii itakuwa 28. Hii itakuwa ngapi ya mwisho hii? Ya 5. Ya 5 itakuwa ngapi? Ya 5 itakuwa ni 26. So the other thing that I'm so sure so many students could not see, we also introduced this thing of finance cost. The interest, not number 7. So many people could not really bring. Some people are able to get this, but again, you know, when you get this, we like twisting you the other way. So in this case here, kuna interest, ladies and gentlemen, here is 2 million. 2 million per year, like that. So you don't forget this. Let's just take care of them. And then now we have the other costs, like operating costs. So operating cost, we're given a figure of 5, 10, 15, 12. And then lastly, we have the selling and administration costs. Selling and administration cost. So selling and administration cost, we have 10, 10. We have 8, 9. 8, 9. And then we have got 11, like that. Great. So then could you kindly give me this profit, ladies and gentlemen? Please give me the profit very first. So this is the profit before tax. Profit before tax. Fortunately, don't have any depreciation here. And then, of course, we have the tax element, right? And I would want to see now you guys finishing this entire question. And if possible, you send your answers on WhatsApp. You send your answers on WhatsApp. So that we can get to compare notes. Otherwise, it has been a great session. I've enjoyed hanging with you guys tonight. You know, this is a hangout, right? Right. We're not enemies. I'm not your examiner. We're not enemies here. All right. So we shall overcome. So ensure that you finish the entire questions, testing you, especially on how to get this PO when we have infinity. So ensure that you finish the entire question and then you send your answer on WhatsApp without fearing. For the new students, please don't forget to give us a call. This is our school's number, 0719525000, very important number. And then we have, ladies and gentlemen, here, if you want to talk to me on WhatsApp, sana 0721 620 183.